Hello, everyone, and welcome back to another episode of Cryptonomics. As always, this episode is brought to you by Witham. I'm your host, Mark Eckerly, and please welcome to today's show our guest, Zach Hogg, controller at Solana Foundation. Welcome to today's show, Zach.
Thanks, Mark. Thanks for having me on today. Excited to chat about Solana and my experience in the Web3 industry.
One thing I always like to start on with all of our guests is the crypto journey, the rabbit hole experience, and a little bit about your background, right? So tell us how you ended up where you are today.
Well, I think like most people, you probably could have started the journey a little earlier. So I was studying at the University of Waterloo, finished up there around 2014, 2015. But of course, during that time, Vitalik was studying at Waterloo. So to give you an idea a little bit about could have gotten involved a bit more in the space a little earlier if I had a bit more curiosity. But once I finished my school, did my master's of accounting, came down to New York and was working with PwC for a couple of years, working with some fintechs where I was like exposed to teams that were very lean finance teams that I thought was pretty cool, getting to work with VP finances, controllers, getting to see how to run like a smaller business that was venture private equity backed. And so spending more time with public clients wasn't as interesting to me. And I had a friend of mine from school that got me in the loop on what Bitcoin was. He exposed me to this industry in terms of just casual conversation. Tried to learn a bit more about it as you do, trying to read some articles or newsletters or Twitter screenshots. It was middle of 2020, summer of 2020, and I figured the best way if I wanted to continue to learn about Bitcoin, Ethereum, I was going to have to work in this space. So I took it upon myself to find roles where I could be a number 2 or a number 3 on a small finance team in some sort of crypto business. And I applied to a little exchange called eToro, and they're big overseas, and they're now a publicly traded company. But back then they launched their little money services business in I think June or July of 2019. But back then the brand wasn't as well known, right? But I think I applied to eToro once or twice through LinkedIn, and there might have been like 10 or 15 applications. And so it was really just a numbers game of being lucky enough to get seen on the list of applicants. And we did a couple calls and hit it off from there. And so I was hired as an assistant controller with only about 5 years of experience, getting to run the finance team, help them build a finance team from really 0 to 1. There was a controller and myself, and then we eventually hired a senior accountant. But we were basically insourcing the accounting and finance operations for the U.S. subsidiary, which was a great experience. I'd say like working at exchange is good to get some exposure. You're kind of foot in the door. Then you figure out like what kind of drives the markets a little bit. Like an FS business kind of adjacent to crypto, you kind of see like a market cycle, kind of see how things work. And then from there, it's like, okay, I kind of have an idea, but it's that same conversation that you have in your head, which is like, okay, I kind of learned some stuff, kind of know what I'm doing, but if I'm going to learn and know more about it, I need to actually do more, which is not who's trading Bitcoin or who's trading Ethereum or who's trading Dogecoin or Shiba. You need to like go into it further, which is why I was like thinking about people working at a layer 2 company, Bitcoin miner, some larger validator, or going to work at one of the largest layer 1 blockchain foundations in the world. So I was very fortunate to find a role that I did at Solana Foundation, which is doing the same thing I did at eToro, right? Which is building an accounting and finance operations team from 0 to 1 as like the first in-house CPA.
Yeah, it's neat to hear, right? Going back to your earlier point where the personal curiosity kind of turns on and you start doing some diligence yourself and reading about it, following the news, maybe updating the Twitter feed a little bit. And then you went fully in. So tell us about that journey, that differing in your career path where you went from traditional public accounting to Web3 company. Your day-to-day, I'm sure, had to change, right? Being a controller, financial reporting, soup to nuts is still the same, but what does that look like now being a Web3 controller working at one of the largest companies in the space?
Right. So I think one thing to caveat is that it really depends on how your business is run and operates, right? So if you work in exchange, you still might be dealing very heavily with the movement of money and then valuation of assets, right? So if you're an exchange that doesn't actually make its own trades, custody assets uses like a third party, let's say, you might not ever be involved in touching anything on chain and having to deal with any of the accounting for it, right? So you might be booking movements of trades and not touching it at all. So there's like certain levels still how this might be. Or let's say you might be working on building some sort of consumer app And this consumer app might, be taking some fees, but it might just be like a pure technology type service. So like you might not actually be involved in, unless your business is actually collecting payments or making payments on chain. There might actually be less involvement in terms of how the business is run on chain, unless you're actually custodying assets. I think that is like the most important point to make, is if you're the business that's building on chain, the actual more complex components of the accounting comes from actually running the business on chain, actually making payments on chain, receiving payments on chain, and custodying those assets on chain in order to do so. Those are the components that make it more complicated. Because like you said, at the end of the day, you're making the same product. You're still going to make a financial statement in your reporting currency, which is generally going to be, for most listeners on the call, US dollars, right? So it's those transactions that you do on chain, or those assets that you hold on chain in those, we'll call it volatile or an implied FX to the reporting currency, that actually create those other complexities, which I think makes it interesting, right? Because you're running a company and a core business runs like an implied, foreign exchange, right? So by service level, the entire accounting or financial operations is already more complex just from the get-go, right? What I've found from my experiences is the actual usage of the digital asset, paying for expenses for it, having to work with, valuation of what those expenses would be, selling certain assets, the evaluation for those, and dealing with impairment models and so on, or, different ways to value financial instruments is what makes it even more complicated.
And to follow up on that, that does help make your job simpler or easier, right? And especially being now at your second crypto company, I'm curious what you could share with our listeners as far as reporting tools, software automation, anything that you use on your day to day or that you have found to make it easier, you'd recommend.
So in my bias is that the way that, businesses like ours will continue to become more efficient or have better financial operations internally, is the more systems that are out there that actually can do both, can deal with fiat transactions and deal with on-chain transactions. So there's a caveat there, which is like, a crypto subledger today is going to be just a crypto subledger, because that's what its purpose is for, is to take your on-chain transactions and turn them into actual financial accounting related information. So generally your base level is you've got your Web2 systems, like an AP system, like a Zero, like a NetSuite, that can handle the basic rudimentary tasks of like, okay, I got some dollars, I got some expenses in other currencies. We're going to go pay those multinational payments and whatnot, and those are going to flow into our accounting system. But for everything else that's paid on chain, we're probably going to have to do something where we're using another tool outside of the normal processes to make the payments. And then we're going to use another tool like a subledger to then interpret all the on-chain information, turn those into actual dollars for accounting purposes, and then make some journal entries out of that. Yeah, my bias is that, the more systems that I see that are Web 2 and Web 3 combined natively, the better. Because I think if anything, we want to get to a state where it's like Web 3 only, or Web 3 is the driver. But I think what I've seen most useful today is financial tools that can allow you to get in and out of both assets, right? So like there are companies that are building tools where you can make payments multinationally with fiat, with stable coins. And generally it's allowing you to do stable coins as a rail to make those last mile payment in a different currency. Or there's tools where there's companies that are building fintech or bank accounts where it's built on stablecoin rails. So you can move in and out of the fiat currency or the stablecoin as you wish, or receiving stable coins, but holding them as dollars. That functionality to move back and forth becomes ever so more vital as the more that you do on chain that I've found. And then otherwise, I think, again, it's like just figuring out ways to make payments. So when we're making payments like out of a bank, my prior employer, we would do all these wire files, right? Where we're making payments in the bank. We got a batch of payments. But we still want the ability to submit, approve efficiently, but with controls. And finding that on chain is just as important, right? So like you might have like a bunch of on chain payments to make, but we want to make those efficiently. We don't have to want to click through a bunch of screens on someone's mobile wallet or like on a Circle Mint account to just make payments one by one. But then two, we want a way we can load those efficiently, systematically, but then also have appropriate controls to improve those and not have to, let's say, like sign those like 4 or 5 times each, right? So Those are like kind of the core principles that I've always been looking for tools that actually help us on the on-chain part of the business, but also help us with like the Web2 legacy banking needs as well.
Yeah, and it's important to put that into perspective because you're seeing more and more, right? If you asked 5 years ago, 6 years ago, a lot of companies would have very little activity where you could get by with those subledgers that roll up to your traditional accounting software. But now it's we need a one-stop shop that's bridging the gap between the two. It's what is one that could speak both languages at the end of the day. Because you're seeing more and more companies just like you guys like transact in digital assets while also transacting in traditional fiat currency. And sometimes multiple digital assets and multiple fiat currencies. So how do I not just speak one of each?
Exactly.
It's we're going fully in on both sides as the space continues to mature, continues to escalate. And frankly, more and more companies are just getting into the space that are not traditional digital assets. So you're seeing a lot of that commingling in nature now, where it's you really got to figure out what's going to be that solution that kind of comes out on top.
Right. Exactly. Exactly. I'm sure there'll be eventually be some sort of consolidation in the space, especially on the subledger side. There's so many of these different tools that come out. I remember like a year or so ago, I was demoing and testing out every new tool that came to market just because they wanted us to see the tool. And obviously we have a business that's running on the Solana blockchain. I want them to have access to good tooling for their needs. And so like it was like, imperative to us to like test out tools and give feedback so that improves everyone's like experience.
Yeah. Yeah, and even think about what's coming down the pipeline too, where you're going to have such granular reporting with the 1099 DA, the cost basis tracking, and making sure that as a company, all your ducks are in a row. You know your basis by asset class, by tranche. So it's just going to have to get even more specific on the accounting side. So our day to day is going to become use the word loosely fun.
Yeah, right. Again, that's another complexity to just the surface level, which is every potential wallet will have its own cost basis. I'm a little privileged in that sense that the Solana Foundation is based in Switzerland, so it's one of a number of Swiss-based foundations and Web3 private foundations in Switzerland. For us, when FASB comes out with new rules, doesn't necessarily implicate or affect us from that sort of reporting lens. So for the time being, an entity like ours or other non-US entities might not have to think about that insofar as if they have any US operations or US subsidiaries, they need to think about the differences. Think about how simple they want to try to make other operations to try to smooth out and not create too many complexities that are just unique to one operating entity or a devco or service entity in the US.
Yep. Okay. So let's dive into the Soul token a little bit. Can you give us a high level 101, the tokenomics, right? What are some of the core utility traits of Solana and users and the benefit of holding Solana?
Yeah, so Sol itself is a delegated proof of stake and blockchain network. So it's a little different than like Ethereum proof of stake. You've got a inflation schedule and that mints out new Sol every epoch. So for those that stake with the network, they lock their Sol up with a validator. There'll be new Sol issued every epoch, which is generally speaking every 2 to 3 days. And every year, that inflation amount adjusts by roughly 15% downward. So over a certain period of time, the terminal inflation rate of the Solana blockchain will be approximately 1 to 2%. So the way that works then is similar to fiat sort of structure where you deposit your funds with a bank account and then they will issue interest on your deposits so far that insofar as you have a interest bearing account. The way that the actual new issuance of the asset works is there's a certain amount of SOL that will be issued over a period of time. That amount of SOL that's issued is based on the entire network, right? So it's similar to like any other asset where there's like a new issuance. It's a nominal return based on the rest of the holders, right? So if all the SOL was staked, every new issuance of SOL would just increase the number of SOL that you had, but all the ownership would remain the same. Whereas there is generally about 50 to 60% of SOL is staked today, generally. So that return that you're making is really just a return against the other holders that are otherwise not being staked. And the interesting thing about that is like effectively that gives you like a risk-free rate. So the differences of like SOL versus other like proof of stake networks is SOL itself is delegated proof of stake. So you delegate your SOL to a validator, but you don't actually give up the control. And we'll get into how that works in a moment. So you've got delegated proof of stake, where the validator doesn't own the SOL, but can use it to validate transactions, secure the network. And then you don't have slashing is not yet a concept in the Solana blockchain. Really, the only risk is a risk of like opportunity cost of like, I could stake it, I could earn my, roughly 6, 7, 8% nominal return against other holders, or I could then, use the SOL in decentralized finance, lend it out, do something else like a stake pool. Mm-hmm. It's really a opportunity cost type scenario that gets presented, and it's really effectively like a risk-free rate against other holders. And so then you ask like, okay, how does delegated proof of stake work? How do you not give up control of the SOL when you're doing the staking? And so what's unique about Solana is any sort of address you have on chain that you generally would synonymize with being like a receiving address is a withdrawal authority address. So what a withdrawal authority address is as a main receiving address is it can own other addresses. And so we'll break down what those addresses could be. Generally, when you receive another asset on Solana, other than SOL, so like if I was to send you USDC, USDG, what you'd actually receive is an asset on a different receiving address or a different account. So you would have what we call a token program account that is owned by your withdrawal authority address. And that token program account represents that SPL, Solana Program Library asset that you own. For however many assets that you own, you have a token program account specific to that asset. So that is an interesting trait, which is that products like Circle, for instance, like you might have certain addresses to receive USDC. Now, the way that works with Circle is you just have a token program account that they own, but it's your specific token program account is associated with your Circle address. Right. So you can technically send this asset to that token program account, but it's just when the warnings go off on your wallets. Be sure what you know that what you're doing, because if you don't send the right asset, it's not going to land.
Is that similar to how on the Bitcoin blockchain you have a parent and child address? Is it similar to that where you have one token program account with multiple assets living under that, maybe in their own wallets, but it all rolls up to one?
So the so it's a little different than the UHD structure, because I think that's also a way for you to only use one Bitcoin address and then to not use it again. So it's a little bit different because you need certain tools to determine what assets you own, which is on Solana blockchain. If you know like a receiving address, a withdrawal authority address, it's all public. It's all out there. You can just look it on SolScan. You can see okay, this withdrawal authority address owns these assets, these token program accounts, and then it also owns these stake accounts, which we'll get into in a second. But if you were to look it up the reverse, you can do the same thing. So if I go and look up an account, it actually happens to be a token program account, I can see right on the Block Explorer on chain what address actually owns it, which I think in the Bitcoin UHD sense, I think it doesn't really work the same way. But in terms of a parent-child structure, there's also just stake accounts. And so this is where you'd actually stake your SOL. So again, where we're thinking about withdrawal authority address and you got your token program accounts for every asset. In order to stake SOL, you have your withdrawal authority address, and then you make a stake account. So you create a new account on chain that is just specific to staking. And the reason you do that in order to stake, and the way this is all set up, is that when that stake account is created, there are up to 3 authority addresses associated with the stake account. And this is what creates the ownership. So there is what's called the withdrawal authority on a stake account, which is going to be your withdrawal authority address, your main receiving address. Then there's also what's called the stake authority address, which is, generally speaking, when you create a stake account, it's going to be that same withdrawal authority address. And so that gives the right of the stake account to determine where to delegate, like where to actually stake it. Whereas the withdrawal authority address is actually the address that has power to withdraw assets from the stake account, effectively the true owner. And there can also be another authority on a stake account, which is a lockup authority address, which is how lock SOL becomes to be. Because if I was to send a stake address to someone, I can add or create a lockup authority on this address and say, I want it to unlock and be available for withdrawal at a future date. And then that creates an actual programmatic lock on chain, which then once that time period passes, the lockup authority deprecates. The withdrawal authority address can then withdraw or change withdrawal ownership rights on a stake account as well. So that's how staking works. And so when I have funds in a stake account, I can then choose to delegate the SOL to a validator. It will then have a validator vote account associated with those assets. But during that entire process of delegating, the withdrawal authority address doesn't change. So I still have the withdrawal authority rights. So the validator has the rights of voting, but I, as the withdrawal authority address owner, still have the withdrawal authority to withdraw that SOL, to undelegate, and then withdraw later. So that's how in a delegated proof of stake concept, you're never really giving up the keys, you're never really giving up your SOL, and that is in the confines of native staking. And so that's also how like Marinade Native works. For example, you would go and give up the stake authority rights of your SOL, but you still have the withdrawal authority rights. So when you go to unstake it, Marinade will then go unstake it, but you'll always hold that SOL within your own wallet, which is different than how stake pools work, right? So if you go and move funds into a stake pool, you then are exposed to smart contract risk, because then you are moving your SOL into another asset. They are supposed to be going and staking it or holding it and whatnot. But at the end of the day, it's not through that native staking, delegated proof of stake sense. It is actually relying on someone else and a smart contract to do what they say they're going to do.
I was just going to say, to kind of break it down for our listeners a little bit, the native staking is when you're doing that yourself as the user.
That's right.
You're directly plugged into the network, the ecosystem, as opposed to probably the common approach that many folks do it, where it's just, I'm holding my assets on Coinbase and I click the stake button. Right.
So
that's the staking pool solution, right? Where
you're that's actually a great question and a great point, because you'd think in most cases that, if I'm holding assets on an exchange and not staking, it might just be like I'm lending it out with them. They're rehypothecating. You're never really 100% sure, unless maybe Coinbase is publicly traded, so they might have some more reporting available. In this actual case of staking on Solana, Coinbase has a validator, and it is probably one of the largest ones in terms of stake on the network. And that is because every time someone stakes with Coinbase, that SOL gets sent to that validator through their own backend systems. It gets sent to their validator and is actually natively staked on chain. So it's still a counterparty risk with Coinbase. It's not exactly the same as delegated proof of stake, because at the end of the day, you are giving up your assets to Coinbase when you're holding it with them. But technically, the way that it's operating on chain is the same mechanics. Like you delegate that SOL. That SOL is with the Coinbase validator vote account. It is technically staked on chain.
Yeah, because I just wanted to call it out, because you made it an example of when you want to delegate these assets for staking, these new wallets are created.
Yeah.
All of that is happening behind the scenes when you click that button on Coinbase, because they're doing it on your behalf, essentially, right?
That's right.
So they're pulling customer assets if you and I both were to go to do it on a Coinbase platform, as opposed to me as an individual retailer doing it myself and seeing all those different moving parts.
That's right. Yeah. So like someone like a Coinbase would have some sort of internal ledger on their back end saying like, okay, we've got a certain number of assets here that are not staked, a certain number of assets that are staked. And then they would go through their own movements, turning their internal ledger into on-chain transactions separately. So like, okay, we have this number of SOL to be staked. Okay, let's move that SOL over to the validator now.
Okay. And going back to one of your earlier points, the inflationary model and the way you were breaking that down, how new SOL was introduced into the ecosystem, would that be similar to how Bitcoin is releasing new coins every 10 minutes as blocks are mined effectively, right? And is there a fixed supply like Bitcoin, or is that just number going to decrease with SOL?
Yeah, so it's a similar concept, right? Like proof of work is compensating miners for processing transactions, processing blocks. It's the same way that in the proof of stake lens, the inflationary rewards are intended to compensate the validators for securing and providing transactions and decentralization to the network. There's a similar idea of like a depreciation model of like what that block reward is. and obviously it cuts in half every 4 years on average. The model then says at a certain point in time, we are going to stop the halvings and we're going to just stop at 21 million, right? That is a concept just specific to Bitcoin. In terms of the proof of stake on Solana, technically one would say the maximum supply is infinite because it eventually hits a terminal period where the inflation rate is approximately 1 to 2%, right? So that technically then means that the maximum supply, there isn't a technical number. However, there are plenty of people out there that are pushing for the inflation schedule to be tweaked, right? So like this inflation schedule was pushed out when the blockchain was launched, and we said like, okay, we're going to start it whatever number was, like 10, 12, 15%, and it's going to cut every year, and we're going to get to 1 to 2% by the end of that. Now, some people are saying, well, Sol is very efficient. It's very fast and cheap. We try to focus on good internet capital markets and market dynamics. But this inflation schedule causes leakage because it's very, very large amounts of nominal returns that create tax questions, create different selling pressure. Does it create more buying pressure because someone's just buying a nominal yield? There's various arguments to be made because of essentially this is just a nominal return. It's like, does that number need to be 7-8%? If I'm just earning a return against the holders that are not staking it, the number could arguably be 0.5%. It's a risk-free return for me staking my Sol for a couple of days, right? So there are entities out there that are pushing for a different inflation schedule to be adopted. So there was SIMD 228, I believe was the right number, but that was a validator vote that occurred earlier this year where there was a proposal made and then became a SIMD and reviewed and discussed. And there was a few open call where some people actually debated the pros and cons of the SIMD. So it actually became popular talking point for a little bit. But the motion eventually did not pass. The validators voted to keep the inflation schedule the way it was. But it makes a point that, maybe in the future, that inflation schedule does look different. But for today, as it stands right now, that's how the inflation schedule works.
Okay. That's good to know. I mean, it's neat to see the democracy of the protocol, right? To show that it does have the decentralized component to it, where it's not just, we want to change it up, right? There's some central authority. So my final question, and talking about some of the utility components of the ecosystem, we saw a big pivot back let's go back 4 years ago now or so, where the whole NFT marketplace was run by Ethereum. And then as Solana gained more market dominance and market share, I think that overtook the NFT marketplace. I'm curious, what other utility props do you see that the ecosystem, blockchain, the underlying tech, what could that come to offer users that we might see in the future coming down the pipeline?
Great question. I think that kind of NFT craze or phase in early 2021 was what brought Solana to prominence, because people started to see like, oh, this network, this blockchain can run very, very fast and very cheap. And so it's like very easy then to issue these assets. Like you go and launch a bunch of NFT packages out there and just send them around. And that's the same thing like with other assets get launched. People will say like, oh, Solana is just meme coins. And it's like, well, Solana is meme coins because it's easy to issue these assets so easily and freely. And so you got like a very fast, cheap, permissionless, like open layer 1 network where all like liquidity can kind of be brought together. Right, so you don't have fragmented liquidity issues of moving in and out of different L2s, which makes Solana a great place to issue these assets. And I think what we've been seeing since that NFT is these RWAs have been a great kind of testing ground for other institutions to issue their money market funds on chain. And so you get to see like, okay, how does the technology work? Now, obviously, these assets are a bit more permissioned, so it's a bit more of a static experience of like, okay, I'm going to KYC with a provider, and then I'm going to get this asset, I'm going to get my address whitelisted, and then I'm going to receive this money market fund as an asset on chain. And I'm going to either receive a rebased price relevant to the earnings on the money market fund, or I'm going to receive sort of like a dividend or reward payment or interest payment. Because of its restricted nature, it's not an asset that you're going to go in and move freely. It's going to be held in a wallet. It's going to increase its base over time. And so there's been other projects that have come out with other decentralized on-chain yielding assets. And so then you have a permissionless environment for these assets. And then from there, you can say, like, okay, I'm going to go and mint like Onyx, for example, on-chain yield. And then I can take that asset and I can lend it out on a DeFi protocol, right? So then these permissioned assets or these on-chain yield assets can then receive further return on that if you so want. And then the next stage, which we've seen, is permissionless on-chain stock trading, right? So X stocks is a product that came out earlier this year. And so then the future is we've had this testing ground of all these meme coin assets trading against Sol. And then the idea is eventually you get through a couple of deregulated type of products and then you get to X stocks. It's like, okay, you could have that sort of action on stocks similar to like a meme coin to your software wallet, to like your non-custodial wallet, where you can just interact with these various assets as you wish. So you can swap in and out of them as opposed to going into like a brokerage account and doing it there.
Yeah, it shows the maturity of the space, showing the various utility props, right? So it started at the NFT model years ago, and then all the other use cases of where we have always been talking about where we think digital assets and blockchain technology could go are actually coming to fruition now, of the vision of what Sol has to offer and the underlying utility of what assets can be traded on
Right.
it. Right? So I think that's the big value prop. That's going to be the market leader in the space.
Yeah. And I think you're seeing it with other actual companies and brokerages, right? So you've got Robinhood that wants to launch its own L2 or launch on an ETH L2 and run their entire company off of it, right? So like people are moving to this model just because they want to move away from the T+1, the T+2 type settlement and get to a place where we can settle. And what we've heard from other money market funds and issuers is seeing the data on chain makes it easier to run and pay interest and all this stuff, even though to a native like Web3 person that might feel not as exciting or interesting experience, there is actually them technological benefits even on the other side.
Yeah, and we're seeing that too with a lot of the big banks now. Everyone's talking about creating their own stable coin, right? And I think it all goes back to that. We want real-time settlement, right? So even if you're buying stocks denominated in a stable coin, it all comes back to the same methodology of it's instantaneous for the retail traders, for the users. Zach, I appreciate the time today. We covered a lot of different topics. I think this was very good education for our listeners. And I usually end our episodes with where can listeners go to learn more about the company. But in this case, everyone knows where to find it, knows what it is. And we learned a lot of good insights on traditional accounting under Web3, as well as the tokenomics and the future value prop of where Solana is going and what it has to offer its users.
Mark, it was a pleasure. If people want to learn a bit more about what the foundation does, they can go to solana.org. And to learn more about the blockchain itself, that would be solana.com.
Yeah, it's exciting future ahead. That's for sure. Well, that wraps up another episode of Cryptonomics. Thanks again for everyone listening.